Hi everyone, thank you for joining me in our executive interview series where we dive deep into the innovative strategies of Australia's most dynamic financial leaders. And today I have the pleasure of speaking with Craig Bannister, the Executive Director of Pallas Capital, a pioneering firm that is revolutionizing commercial real estate development in Australia. And Pallas has an impressive track record. Pallas is redefining how sophisticated investors approach property-backed investments. Craig, thanks for joining me.
Nice to be here. Thanks for having me.
Absolutely. Now, Craig, let's start by addressing something that's truly remarkable about Pallas. So you have deployed over $5.2 billion since 2016 with zero capital losses. Now, that's a feat that's incredibly rare in the financial world. So what are the key risk management principles that have enabled this remarkable track record?
I think we start with the asset class. And for us, the asset class for us is a commercial real estate backed loan. It's called, it's part of the alternative investment space. Other companies out there may be doing similar to us, commercial real estate backed loans, but also company backed loans. So there's hundreds now of these private lenders, non-bank lenders, that are doing certain asset backed lending. We specialise in commercial property lending. So commercial property for us, the typical sort of loan or typical what we do, we're lending to a developer that is improving an asset. They might have land and they're improving that to a development site. They might have a building and they want to move into a DA approval process to create a larger building or maybe apartments. So there's lots of different types of loans that we can do, but the underlying assumption is that all of our loans are, we've done 5.2 billion, as you say. 85% of that is under first mortgage security. Now, what that means is that we're generally lending at about 65% of the value of the property. So when we start the loan, that's our loan amount. The 35% is an equity buffer that sits on top of us. So property prices can and will fluctuate, and we've seen that across, since our time, since 2016. We've had two fairly large price falls in 2018 and 2022 when property markets dropped 15% in some cases, certain more in parts, but generally that was a fairly nasty, quick downturn. And our loan books performed admirably through that time. We had no losses. We had no impaired loans that we couldn't work out. There's lots of problems in these loans. Sure, you get the borrowers are under stress when rates rose, and so it's not an easy thing, but managing that. And you mentioned about the zero losses. It's really the 35% equity buffer that sits in front of us as the senior lender. And that's key. If we're into equity markets and you buy an equity, well, tomorrow the stock drops 10%, you've got a loss on your hands. We have this big equity buffer that sits in front of us. And so being able to manage that, now we have a large internal credit and loan management team. There's over 30 people in this team. They are specialists in commercial real estate debt, lending, and they manage these loans closely. So it's not like we just give somebody the money and expect it back in 12 months. These loan, and the origination, that the management of that is tightly held. We work with the borrowers when they're in stress, and we've done that. We have ability in-house to be able to help them through certain crises, you might say. So the track record's great, and it's wonderful to sit here and say we've done 5 billion of lending with no losses. That's great. I expect that in another 5 years we could be sitting here and saying, what are you up to now, 10 or 15 billion with no losses? That's a goal that we have, and it's an achievable goal. So I really do think that would come through if we stick to our principles of lending where we lend in these areas that we particularly look at as Sydney, Melbourne, Brisbane areas. We're lending across into New Zealand, but they're fairly tight inner city development areas where a lot of our lending is. So there's good demand for those projects. So it's great to see, and that's part of the reason why we've got that zero loss record.
Absolutely. Very well said, Greg. And that's a very fascinating insight into your approach. So great to learn about that. Now, I understand that you're forecasting significant growth in the non-bank lending sector. So how is Pallas specifically positioned to capitalize on this significant market shift?
We go back a little bit here. 2016 is a pivotal year for the growth of the non-bank lending sector. Back then and before 2016, there were companies, firms doing non-bank lending, but they weren't mainstream like they are today. There's a lot of large companies that are well known now, they're well known names. So back then what happened, banking royal commissions basically seized up or inhibited where the banks were lending. And so what's happened since that time, the non-bank sector's grown, the banking, the big four banks, if you like, have stabilised their lending. They still do over 60, 70% of the lending in the commercial real estate debt market in Australia. But that number has shrunk from 90 to 95% back prior to 2016. So in that space of 8 years' time, non-banks like ourselves have come into the market. There's been a progression from these non-banks, how they've grown its capital, how they've grown their capital. A lot of them have high net worth family office type investor base. Some of them have retail money. So they start with that. As they progress through their journey and they get bigger, with better controls within the non-banks themselves, they've attracted institutional capital. And so the likes, for Pallas, for example, we have the likes of Goldman Sachs, Ares and Westpac as institutional funders through our structures. So now that takes time, because a large bank like Goldman's or Westpac or Ares is not just going to give you hundreds of millions of dollars. They're going to make sure that your processes and systems behind the scenes are A grade, bank-like. And that's what we've built at Pallas. And there's a lot of other non-bank lenders out there that have done the same thing. And that offshore money is being attracted. It's offshore money that's coming in, the likes of Ares for us, which is a $500 million injection. Goldman Sachs was $300 million. This is all offshore money that's coming in, and they're looking at the Australian commercial real estate market. It's a relatively stable market. We do have the property price falls. Depending where you're lending, the biggest issue worldwide has been lending into CBD areas, where you've got older buildings that have definitely fallen quite a lot in value, 20, 30, 40, 50%. So we as a lender don't touch that sector. So our loan book has flowed up and down with these 10, 15%, ups and downs on property prices, but we've had no losses there. So offshore lenders are looking at this, being able to manage that volatility, and they're deploying capital. And so they're deploying capital into the Australian market. It's a stable market. From offshore, they can easily hedge the product, and we have a great legal system. So their security, their lending, and how they secure that money is well wrapped up. So they have great confidence in the market, and now they're picking the investment managers to deploy that capital through into the Aussie market. So that trend is continuing. And when we look at the overseas markets, say Europe and America in general, the non-bank lending sector in those two spaces is over 50% of all total lending. In Australia, the non-bank sector is growing, it's 15%. So we have a long way to go over the next 2, 3, 4, 5 years. How does that happen? It will be the offshore money that's being attracted to this. As the non-banks get larger, they get stronger, and they are able to attract more offshore capital. So it's a good growth story, and I think in next, this 5 years' time, 10 years' time, the non-banks are certainly getting bigger and bigger. Yeah.
Absolutely. Now, let's look at a specific example of how this actually plays out. So the Ruby House project in Double Bay is offering an impressive 11.55% per annum yield with a 65% LVR on completion value. So what makes this particular investment opportunity so attractive in today's market?
Okay. So that's a standard for us, which would be a 65 LVR lend. It's a construction loan. So where the money that we've raised from the investors at 11.55 is helping us build as the lender. We're not building it. There is a builder on site called Lords Group, and Lords is building that development, which is a 5-story commercial building. So as of now, that building's been going for approximately 18 months. It's coming up to the end. So by June to September next year, the building will be complete.
Right.
And we do have that as an open for investment opportunity for investors to come into that loan. There is still a cost to complete, so we're still raising capital from investors to fund the project. And the beauty about that building today, now, if you look at the investment, the building is 3/4 complete. There's a big hole in the ground, and now they're starting to build the lower levels. So as an investor, you can look at that and say, okay, it's a de-risked investment because you've had DA approval. You're now just into the building phase. You've got a competent builder on site, so I don't expect there to be any issues with the build. It's a time factor. It's now 6 to 9 months until the whole building completes. Then when that building completes, how does the investor get repaid? It's through the waterfall. It's the back end, how that building is, the end usage of that building. In that particular building, there's 31 spaces for strata office sale. 11 have been pre-sold already, and there's 3 retail tenancies that will be restaurants in that area. They're all fully taken up, allocated. So at the back end, when construction completes, those strata office sales complete, that money comes to pay off the construction loan that we've originated. And if there's any balance of strata offices, Pallas Capital would arrange for a residual stock loan over the balance of the unsold apartments. And that's a new loan opportunity for investors, but it pays out the existing loan. So in a risk strategy reward, the building's got 6 to 9 months to go. You've got the 35% equity buffer. You're getting this 11.55% return, and you are first mortgage secured. So the first 65% of that debt is to be repaid first before the owners are able to take a cent out of the building. So that's the great security about it, and that's where you can sort of say, well, how could we lose money on that investment? Well, the value of the building's got to fall significantly, and you've already got almost half the building pre-sold. So it's very hard. It's a very low probability that you would ever lose money on that investment.
Yeah, absolutely. And that's a very compelling investment opportunity. Now, Craig, I noticed your funds incorporate various protection mechanisms, including first loss capital buffers. So can you elaborate on how these structural protections work to safeguard investor capital?
Yeah, first loss capital protection. So we first started offering that in one of our wholesale funds back in 2019. We launched our first pooled mortgage fund. And that fund, it has now $220 odd million of investor funds in it. The money that's in that fund can help originate loans that are 65 LVR in valuation, against valuation. And there might be 100 different loans in that portfolio. Now, if one of those loans had an impairment, the asset itself had a problem, and the value of that dropped from 100 down to, say, 50. It halved in value, and we had to, as the lender, if the only way out of that situation was to take possession of the asset, mortgagee in possession, and sell the asset, and we got 50 cents in the dollar, then we have a loss. If our loan was at 65 previously, we've got a loss on our hands. Now, every loan that we originate has certain security features behind it. One is the mortgage. We own the land under mortgage. The second one is that we have a company guarantee over the borrower. And then we have a personal guarantee from the director or borrowing entity, the sponsor. Now, they're meaningful in our world because the loan ticket sizes that we generally do, Pallas, is a $5 to $30 million loan space. So if we're doing that type of loan, we know that the sponsor is worth multiple of that. If we were doing a $300 million loan, the personal guarantees aren't going to be there. They'll fall away. They're too large. So we'd come back to that. So every loan there, now the process would be that asset has dropped in value. We've sold the asset for 50 cents in the dollar. We've got a loss. We would chase the company guarantee and the personal guarantee. If by chance they both fell over, then there's a real loss to that fund of, call it 15 cents in the dollar, the 50 to 65. Our first loss capital protection then comes into play. So we've invested into the fund. Pallas Group, if you like, the company has got $5 million of our own money into the fund. Now that could be used against any loss on any loan that's in the fund. So in that case, in that scenario, our $5 million would be utilised before the investors are hit across that portfolio. So all it does, it just mitigates the risk. If the whole portfolio was sitting at a 65 LVR, then the real look-through to the investors isn't 65, it's a bit lower, you know. So we've got this first loss capital sitting there. So it's our way of investing into the fund. We put our own money into the fund, and should something go wrong, it's our money that's going to get hit first before the investors. So we're first to take the hit. And look, you know, the history of our lending since 2016 is we've never had a loan that's gone into that sort of scenario. We've had loans that we've taken possession of the asset, appointed a receiver, and sold the asset. So that's happened 6 times for us across our history. But each time that's happened, we've also got out above, you know, our 65 LVR. We've never sold the asset below that thing. So we've recouped all of our money again. But that's the scenario. That's what would play out if those, you know, those other protections fail, the company guarantee, the personal guarantees fail, then it comes to us, and that's our first loss capital. So it's there to help the investors along the way.
Amazing. That's brilliant, Greg. And that's how like you're protecting the fund, which is wonderful. Now, Pallas Capital's connection with Fortis, who are a development manager, it seems very different from typical market relationships. So, how does this partnership enhance your ability to assess and manage development risk?
Fortis and Pallas, it's a unique relationship. You know, there's a lot of lenders in the marketplace, none that I know that have a development arm to one side. Now, Fortis is a development manager for us. So how that works, the principals of Pallas Group buy an asset, buy a site, and we've then developed luxury apartments or commercial office spaces in Double Bay is a big area for us, South Melbourne, down in Melbourne, Cremorne and Richmond areas. So when we buy that site, we then appoint Fortis as our development manager. Now, Fortis is a team of people with about, I think there's 60 people now in Fortis. The vast majority of those people are development managers, senior, junior development managers. And so when we buy the site, we appoint Fortis, and Fortis is responsible for taking that project from when we buy it through the development phase and through to completion. So they would do all the planning through council. They would external architects or design sort of elements. And that's what Fortis does. Now, on the other side, Pallas Capital is a lender. So we lend to developers. Not dissimilar to what we're doing ourselves under the Fortis Development Management brand, if you like. So as a lender, we see both sides of the market. We see third-party borrowers coming in with a feasibility study to build luxury apartments. Fortis is doing the same thing. So we can see, we can compare, and we get great insight into the marketplace. What's the price per square metre that these guys that are Fortis are developing? What works? Because your feasibility over here might be out. And so we have great insight. So look, guys, we're developing just around the corner from you. Your numbers won't work. So we can give great advice at that point of time. You know, some of the loan opportunities that we've had come across our desk, we've been able to say, we just don't see it working for you because we're in the market ourselves and we know what's happening, what's working, what's not. So that relationship, Fortis-Pallas relationship, helps us in so many ways. We have utilised the skill sets within the Fortis development team, that there are development managers there. They've come across to maybe help or guide or give guidance to the third-party borrowers. Might be a planning issue that they've gone, we've got an idea. We've done something ourselves through council that might have worked, try this. So we've been able to help third-party borrowers from the relationship that we've built in-house with Pallas and Fortis. It's very unique, it's great. I would say it's been used against us in some parts negatively because people think that Fortis is a developer. Well, Fortis don't own anything. And whilst Fortis keep growing very quickly, that's the other amazing part. People say, gee, Fortis, there's another development going up with Fortis. Well, Pallas Capital is the arranger of finance. And so we arrange money to lend to third-party borrowers, developers, but we also do the same thing under the Fortis brand. And so we have high net worth investors in the Pallas Capital network that will only invest into Fortis developed projects. Because of, it might be the location, Fortis is a eastern suburbs centric developer in Sydney and in Melbourne for that matter. So they're building luxury, beautiful product. Their track record's fantastic as well. They've been going since 2016 and their developments are winning awards and they're doing really well. So some of the investors only want to invest into the Fortis stuff. So Fortis can keep growing, if you like, the number of projects that they're on, because when we buy a site, the funding of that site is coming in from the investors taking a piece of that development. They're helping fund it maybe under first mortgage, maybe it's under a higher yielding second mortgage or a preference equity where we're sharing some of the development profits with the investors. So it's unique, but it's been a wonderful thing for us internally, but it's a less well-known external. So maybe this video will help by people understanding finally that, oh, okay, I get it now. Fortis is a development manager and they've grown so quickly because of that association with Pallas. And we've been able to fund it through the investors wanting to invest into those projects.
Wonderful, Greg. A truly remarkable partnership at that. Now, speaking of difference, so with rates stabilizing over the last 12 months, can you tell us how does Palace structure its loans and manages its portfolio to maintain those consistently impressive returns for investors?
So with rates going up, stabilising or down, the structure is the same. When we make a loan to a borrower, it's generally at a margin over the bank bill rate or the cash rate. So let's call it a rate of 7.5%, 8.5% to the borrower plus the relevant cash rate. That would be our rate to the borrower. How we fund that is then we offer the investor base a margin below that rate. So if it's at 8% to the borrower, maybe we're offering it to our investors at 6.5% plus the BBSW rate or cash rate. So whether that margin goes up or down, we can maintain that margin for Pallas Capital, and that 1.5 margin generally turns the lights on for us and makes us the money. So that's our spread, and it's clearly set out in all of our IM. So it's that spread is a known spread for the investors. They understand that's it. So if rates drop into next year, then the returns, the borrowers will pay slightly less if rates come off 50 basis points from RBA. The borrower is paying 50 basis points less, but the investor is going to get 50 basis points less on their return. It was 6.5 plus BBSW, which is currently 4.3. That 10.8% return drops to 10.3. The borrower also pays 50 basis points less. So that's the structure of all of our loans. And we can maintain that through a stabilised market, a dropping market, or when rates start to increase in the next cycle, the same thing will happen.
Right. I understand. Now, Craig, we have been working together for a while, and Pallas Capital has also participated in few of our investor events. So it would be great to hear from your perspective, like how do you think platforms like Wholesale Investor have been instrumental in helping connect companies like Pallas with sophisticated investors and communicate the investment opportunities?
I think it's been awareness. What we've done, we've been with you now at least 2 years.
Yeah.
So we've been at the conferences,
Yeah.
we've presented there, we've had a booth,
Yeah.
and I think the booth has been instrumental in probably us and that relationship being a good relationship, because we are manning that booth, and across the day or 2-day conferences, people are coming up and chatting to us. And maybe they're aware of the space, commercial real estate debt space, maybe they're not. There's a wider range at your conferences of different types of investment opportunities. It's broad. So as an investor coming along, you'll see lots of different things, from sort of high tech to biomedical to commercial real estate debt. So for me, it's been, I think we need to put the time in, the time to go to the conferences, man the booth, be there, talk to the investors, and then that's paid dividends for us over our 2-year relationship. So thanks for organising the conferences, and happy to be at the booth.
Thanks for working with us. It's truly been such a wonderful partnership between Wholesale Investor and Pallas, and our team really hopes that it continues over the years. Now, for our viewers watching this interview who are intrigued by Pallas Capital's approach, contact details are available on the side of the screen or in the description of this video. So please feel free to connect with the team at Pallas. And Craig, your insights today have truly been so remarkable, and the innovative approach that you and your team are working with at Pallas Capital, it truly shows like where Pallas is today in the commercial real estate debt investment. So thanks for joining us and sharing these wonderful insights.
Well, thank you very much.
It
Very
is our
enjoyable. Thanks so
pleasure.
much.
Thank you, Craig.
Thank you.